we're going to start off with Elise and Colby from the financials and real estate sector on their pitch for Goldman today. So you should have access to just share your screen, either Elise or Colby.
Okay.
And if not, Sasha, can you make them co-host?
I already did. Yeah, they should have access.
All right, give me 1 second and I will. See. Okay. All right. So today Colby and I are gonna pitch Goldman Sachs, and like we were kind of talking about before, I don't know if you guys all heard this, but we talked about it with the advisory board, and they had a lot of input on the ESG section. So I'm gonna like really dive into that, and I have a lot of notes to more so dive into it, so I could send out a follow-up email with like more information on some of the comments that they had. But there is still a lot on ESG in here, but just as a oh dear, why can't I move to the next? Huh, that's weird.
If you want to take it out of presenting mode, maybe that'll help.
Yeah. Oh yeah, okay. That's what it was. Okay, sorry. So yeah, we're just gonna go over the investment thesis, industry overview, company analysis, ESG integration, and valuation. So Colby's gonna talk about the investment thesis.
All right, so the Goldman Sachs Group, it's an effective asset manager with a strong global reputation. Everybody kind of knows that name, the Goldman Sachs. They had last year, ending December, they had higher revenue driven by asset management and global market segments, offset by increased litigation expenses. But in 2020, they also obviously faced major setbacks along with pretty much everybody else from COVID-19. Due to this, we saw a major price drop. However, this allows for higher returns. And so we think that the company's efforts to return capital to its shareholders should boost investor returns in the coming years. Basically, overall, panic selling led to a decrease in the price along with litigation costs. But for the future, these two events should not significantly impact the long-term value. So, Elise, did you want to talk a little bit about the ESG factors?
Yeah, I'm going to go into it in more depth, but one of the most major things in the news right now is that they said that they were going to invest $750 billion in sustainable and finance, and that's heavily catered towards climate change as well. And like, again, I'm going to talk more about that later, but that was something that's great in the news. And another thing that I love to see was that they said that they were going to have 50% of its global workforce be women in the upcoming years. So they're striving towards that goal. They said that in 2018, they're doing a really good job of that so far. And you'll see that with the executive board and everything later on as well. But those are two major things that I want to highlight.
So with the $750 billion, just a quick question. I know one of they're focusing that capital deployment across two secular themes. One is climate transition, because we're going into a low carbon economy. Do you know what the other one is? I'm just drawing a blank.
Yeah. Hold on. I have it right here. So climate transition and inclusive growth.
Okay.
Those are the two themes. Yeah.
Okay. I was just curious.
Yeah, so honestly, we could probably just we can just go into the industry. I'm going to talk about the price target and stuff that we got later on when we do the valuation part. So, and then the risk too, we're going to go over. So just looking at like large banks as a whole in terms of the industry, a couple of trends to point out, one of them being digital transformation. So all of these banks are specifically trying to design new things online and easy access for consumer experience. Accessibility and convenience is really important to clients, and banks that are able to provide this usually retain their clients pretty well. Additionally, there's ongoing regulations and disclosures. The investing world is obviously just a highly regulated environment in general. So keeping on their governance to make sure that they're in compliance with ongoing regulations is extremely important. And then also employee and board diversity. So this is kind of something that Goldman does a really good job of, specifically with employees, just retainment in general. These employees are really highly skilled, and so they expect a lot. And so I think Goldman really does a good job in that aspect. And then going on further, talking about the materiality map. So this is obviously the SASB materiality map. Employee engagement, like I said, was huge. Workers in the industry really are looking at these large banks to do a good job in terms of benefits and stuff like that. Business ethics is obviously a material factor. Not only does it improve reputation, but it also helps regulation compliance, which is obviously a risk mitigation factor. And then finally, systematic risk. So I'll go into systematic risk a little bit more when we talk specifically with Goldman, but obviously just as an investment bank, they rely heavily on the global economy and other market risks that go along with that. So yeah.
I swear, I don't know what is going on. Like sometimes I can move forward and sometimes I can't. How did I fix this the last time? Oh dear, I'm sorry, hold on. Okay, I'm just gonna keep it. Is this okay for everyone? Like, can I just keep it like this?
Yeah, that's fine.
Okay. So the company overview. So I'm sure you're all familiar with Goldman Sachs, but it operates as an investment bank, also securities, investment management, and it has a whole global segment. So there's 4 segments. I'm going to go in depth into those in the next slide, but investment banking, global markets, asset management, and consumer and wealth management. It's been around since 1869. This performance graph is a few days old because the current price is like 180 something. I think that was 5 days, so it actually had a huge growth in the past couple of days, but that's okay. The CEO, so David Solomon, he has been with Goldman Sachs for 21 years. He started off as a co-head of the leveraged finance business. He has a BS in political science from Hamilton. And I also think this is really funny. So one of my friends interned at ACO and told me this, but like you could actually look it up online. He is also known as DJ Saul for producing EDM music, and he has like had concerts and he travels and loves to do this and everything. So I think it's so funny. And he just like you can hear it in his voice, and everyone like loves him. He's just a really like lovable guy. Really funny and then like well liked, so that's
He's
always
good too. I would definitely recommend you check out his SoundCloud.
Okay, honestly, I think I listened to one of them once, like when I first found out about this like 2 years ago, and it was it's great. I love that, like you're the CEO of one of the most prestigious banks and you're also a DJ and you produce EDM music. Like that's so great, and they're so like, you know, I don't know, like they're old style, like old fashioned too, so it makes it even better. And in terms of ESG efforts, I already mentioned this. I'm going to go in more depth, but that $750 billion that they just recently pledged this year. So that's huge for them. So this is the business segment. So this was actually for Q1 of 2020. And as you can see, the 4 segments, the largest being global markets and the smallest being asset management. So, and this is by revenue. So for investment banking, global rankings, they're number 1 in announced mergers and acquisitions and completed. And that's huge because mergers and acquisitions is one of the most profitable sections of investment banking. So that's really important for them. And you can see all the other rankings like that they have. I'm not going to read through all of them, but global markets, number 2 in institutional client franchise, consumer and wealth management. So they have some new things going on in that section. They have a lot of new like technological advances. ACO, which I mentioned before, is their like ultra high net worth client base. And then they also have a new integrated platform called Marcus. So it's kind of for like the average person. It has like getting loans, starting savings, checking, credit cards, investing, like all of that. So it's a really nice app. Like I looked through it. It's really user friendly, so that's something that has just come out. And then asset management, that, you know, global scale, 1.3 trillion, 30 plus years. So it's very, if you look at the asset management depth chart of all the different types of asset classes that they're investing in, it has grown exponentially over the years. And one thing that they cite as a positive is that any new asset manager just cannot have the amount of depth that they have, that they've grown in doing this for so many years. So strategies and goals. So this was on their 2019 investor presentation. Their current ROE is 10%, and their goal is to have that to 13 to 14, and then their current efficiency ratio is 68%, and their goal is to have that down to 60%. I think it was like a 5-year term, but I'm not 100% sure. And then this is, again, right off their investor presentation, just like their clear strategies. So growing asset management because it has better margins, global footprint, diversifying. So, they're trying to get into the digital consumer banking, and that's with Marcus, like I just previously mentioned. And then just, being more efficient. So Colby mentioned previously that people are, banks' greatest assets. So Goldman Sachs, #1 most attractive bank employer among business students. It is one of only 10 companies that has been on the Fortune 100 best companies to work for every single year since it started. And also, one of the things that MSCI kind of faulted Goldman for was not publishing employee retention rates, but they do have this published statistic that says 66% of the 2019 managing director class started as an analyst or associate. So that just shows that they have a lot of in-house talent. People are moving up in the company. People are staying there. So although they don't have an exact employee retention ratio, I think that does speak that people are staying there and they're moving up. And, a lot of the higher execs, know the company very well and started kind of from the bottom. So we really, really like that. Revenue drivers. So, the revenue drivers and competitive advantage, they're very closely related. So human capital, again, employing the top people, kind of everything that I just said. Everyone wants to work, well, not everyone, but a lot of people want to work for Goldman Sachs. You say you work there, it's very prestigious. Everyone knows about it. Risk management, customer relationships, obviously like their brand, their reputation. Goldman has an amazing brand and reputation. Technology, so advanced tech, which obviously lowers costs, and that was one of their goals, to lower costs and be more efficient through advanced technology. Marcus is an example of that. And then reputation and integrity. So they are having a few issues with some litigations, and I'm going to talk about that in the ESG section. But for the most part, Goldman Sachs has a pretty good reputation. So that kind of just ties along with the competitive advantage. But one thing to add is the focusing on more profitable segments. So that's them growing their asset, their asset segment and consumer banking, and kind of, getting away from the less profitable segments. So for the financial strategy, ESG, which I'm going to talk about, diversifying, so that in-depth asset management chart, longer term operating focus. So client-centric, they're all about their clients. And then this little chart in the bottom, I'm not going to go through it, but this again is just right straight off their investor presentation, showing how they're trying to grow. And a lot of it has to do with client needs and efficiency. Those are like their two main kind of throughout. The investor presentation was extremely long. I think it was like 200, it was like a 200 slide deck or something. And again, every single slide had something to do with like clients or efficiency. So, okay, Colby's going to talk about risk now.
So in terms of risk mitigation, one of the important things to note is that they handle a lot of consumer data. So trying to make sure that they keep that secure is really important. And one way they did that is designating a chief information security officer. And that person is in charge of a committee that basically dedicates their time to finding new and innovative ways to encrypt and secure their data. They're pretty loose in terms of their actual language that they use in their 10K. I think it's pretty standard that a lot of people don't want to disclose like really nitty-gritty details about what they're trying to do for their data security. But they did say in multiple scenarios that that's a pretty important thing for them. And just for ESG influence, with better data security comes better reputation, more trust, and it kind of shows the effectiveness of their governance. The other risk is systematic risk. So there's a bunch of different types of risk within systematic risk. I'm going to talk about a couple. One being interest rate risk. So obviously, I think it said over 92% of loans that Goldman Sachs has out as of December 2019 has a floating rate, meaning that it's dependent on LIBOR. And so if that rate were to significantly change, obviously that's going to be a big impact for their profits and their ability to take in some money from that. Additionally, talking about regulations. So like I said earlier, investment banking is a really highly regulated industry. So it's imperative for Goldman Sachs to keep their governance strong and making sure that they stay in compliance with existing regulations like Dodd-Frank, as well as kind of keeping up with new regulations that are being implemented. And then finally, just market risk. So just thinking about the global economy as a whole, Goldman does a really good job in their global positioning. And so they're pretty dependent on the state of the economy as a whole. So obviously with something like COVID right now, that's pretty significant for them. But a couple of things that they do to mitigate that risk, they evaluate their counterparties. It's pretty standard, but they do a pretty good job of talking with their counterparties and evaluating them through third parties and stuff like that. And then additionally, in their actual trading strategies, they have a lot of collateral and hedging, which just naturally gives you a lot of risk mitigation and the ability to kind of lessen their losses if they were to suffer from significant risk. So yeah.
Okay, so COVID, obviously you have to talk about COVID. So this was a direct quote from an analyst saying that they recommend Goldman, Morgan Stanley, JP Morgan because of their strength in investment banking, and that even though the advisory might be slow, like increases in trading and debt capital markets will serve as offsetting that. And obviously, like COVID's uncertain, but he says what is certain is that the policy response from governments and central banks is enormous and will keep growing. Quantitative effects was that the profit was down 46% in quarter1. They didn't actually post their 10Q yet, but they did just like kind of give a rundown of revenues and all that. So some other things to think about. So obviously with the 2008 recession, banks kind of learned a lot from that. So banks in general, especially Goldman Sachs, are just a lot better levered to like deal with this, and they're a lot more prepared. And actually, right before COVID, their money market funds were almost like breaching the important liquidity thresholds for the first time since 2008. So it kind of shows how they did rebounding. But obviously, like again, I said they're more prepared now. And we think like COVID, if anything, is just an opportunity like for creating like a buyer's market, and financials are obviously like a good proxy for the market as a whole. So now that the market's down, buying bank at a cheaper price, and then when the market goes up, which most people are anticipating, after the effects of COVID are gone, then the bank will kind of serve as a proxy for that. So that was also going along with our investment thesis, but just kind of our thoughts on COVID. So ESG integration. So again, I've mentioned this a few times now, but they pledged that $750 billion over the next decade, financing and advising companies focused on sustainable finance themes like climate transition, which is really important to our fund, and also inclusive growth. So they also have a sustainable finance group, and they have over 50 employees dedicated to just ESG and impacting investing professionals. So on their investor presentation, they had a whole like slide deck about ESG and the difference between, just considering ESG and then also like having the impact funds and the difference between all that. So they're definitely very knowledgeable on that, and they're taking all that in consideration. One thing that I've never heard of that was really great is the urban investment group that they have. So they've committed over $8.5 billion in creating and preserving low affordable housing units. So for like communities and other community facilities as well. So that's really important. That was something I didn't know about Goldman. And in 2018, they committed to have women represent over 50% of their global talent, which is really great. They were also one of the first financial institutions to acknowledge urgency of climate change. So all the way back in 2005, they had an environmental policy framework and a $150 billion clean energy target. So this is something that they've been thinking about for a while. They didn't kind of just like hop on the ESG wave in recent years, which I also really like to see. And I'm not going to go over all of the milestones, but those are just some more ESG kind of statistics. One that I like is 230 million was invested in women-led businesses since 2018, so that's really great. There's actually a lot of statistics about women-led businesses being more profitable. Not going to go into that, but those have been coming out too. So all this stuff is really, really great, and you could just take a look at that in your own time. I'm not going to read all of them, but so continuing, so this is kind of just all from MSCI. So they have a BBB rating. They're in the top 10 of their peer group. They have a 73% independent board. They're signatory to a lot of ESG things like the UN PRI. And they obviously have the dedicated ESG. And if you look at the graph on the right corner, you can see reported assets covered by ESG report approach. So Goldman is higher than a lot of their peers like Credit Suisse, Morgan Stanley, and other things. There definitely were some that were a lot higher, like UBS is almost 100%. But in terms of like, you know, the major big banks that you consider to be their comps, you know, it's a lot higher. And also with the initiative, the $750 billion, we're obviously assuming that percentage of assets is going to grow, increase exponentially over the next couple of years too. So we see a lot of room for growth in that area. And then the major issue that's going on with Goldman Sachs is the Malaysian government charged 17 current and non-current Goldman Sachs executives in this like multi-billion-dollar scandal. It's one of the largest financial scandals like ever in the history of the world. And so now obviously there's a lot of like questions on whether their, you know, risk management is good and their fraud policies and everything. And I have a little bit more on that too. Let me see what I have here. So I want to read this directly. Basically, Goldman denied the allegations, obviously, but there's some differences, I guess, between the Malaysian, like how their legal system works and our legal system. So it's not just like due process or anything like that, or like not guilty until, you know, or innocent until proven guilty. Like they don't have that notion. So, you know, Goldman Sachs is really upset that they didn't even get to, you know, be heard or present themselves or like anything. They didn't have any opportunities to like talk to the Malaysian government about the filing of these charges. So they're obviously intending to contest these. And again, the CEO is saying that, you know, they have written assurances from the Malaysian government that, you know, the transactions that they were dealing with had no impact on the scandal. And the whole scandal had to do with like taking down the prime minister of Malaysia. So it was this huge issue. But so, I mean, I think with that, yes, it's hurting their revenues because they're spending a lot of money on this litigation, but nothing's exactly proven. They're just allegations. So I think the market kind of like that is already set into the price. And I think maybe like, who knows, it could come out that it's actually, they're just allegations and they're like, nothing's proven. So you never really know with that. One other thing is that all the ESG criteria scores are above industry average, except corporate governance in light of the litigation. So if this litigation never happened, like they would probably be in the A category and have like better corporate governance. And I think I mentioned this previously, they do not report employee turnover statistics, which MSCI like really did not like, but with that 66% of management being analysts, I think that kind of just showcases, you know, that they can retain some talent. And now Colby's going to talk about valuation.
All right, cool. So in terms of the valuation, we used a specific model dedicated to financials that was actually derived from Damodaran. And for anybody that took Peter Tsai modeling, they know that Peter Tsai loves Damodaran. So he's a pretty smart guy. Peter Tsai's a pretty smart guy. Basically, this is a form of DCF basically using growth rates and using their current net income. And we calculated that their value per share should be approximately about $264. And we said, obviously, that it's trading well below that. So we think that this would be an opportunity to buy. A couple of assumptions that we took, one being that the firm is expected to grow at a higher rate in the first period. So if that higher rate were to continue on to other periods, we would see even a higher value per share. Additionally, that growth, so similar to that, the growth rate was going to drop after the first period into a stable growth rate. So again, if this growth rate were to continue on, or if it were to be even slightly higher than is expected, we would see that the value per share would be even more. And for the growth rate, I think we used about 9.87%. That was pretty much an average of analysts, but for a long-term growth rate, analysts had roughly about between 14 and 16%. So you would see a pretty significant increase in that value per share as well. And then, so this is a screen from FactSet. So what I basically did was take the top 2 deciles of the S&P 500 financials and rank them based off of a couple of different metrics, one of them being what it is filtered in right now, which is the PE ratio. So if you notice, Goldman's pretty low on that, indicating the fact that their price is relatively low compared to their earnings. So that would indicate a pretty good buy, especially compared to some of their competitors like BlackRock. JP Morgan's a little bit higher, but also looking at their long-term growth rate. So like I said, it was estimated to be like 14, 16%. This one had 16.2%, which is significantly larger than most of them, other than maybe Morgan Stanley. But yeah, I mean, in terms of their actual numbers compared to their competitors, they look like they're in a position to definitely grow. And I think that they have a better chance to grow than pretty much anybody else that you'd see on this list. So.
And I think, yeah, just adding to that, the net income per employee. So that's really important when it comes to banks, because again, it's the people, it's the like employees that they have and, you know, how competent they are. So I think when looking at that, there's only 3 people on this list, not even 2 people on this list that have a higher net income per employee. So it's just really showing how great those employees are and how efficient that they are. So just in terms of banks, that's like a really specific, thing that you have to look at.
Awesome. Yeah. And then, so that base case price target is based off of what the model indicated, to about a $264 stock price. And with a bull case scenario, so we actually used that 16% growth rate, and we got a $302 bull case price target, which would be a 63% upside. And obviously with that, we would have to see an increase in just the global economy as a whole. And with that, that could lead to more investments coming through Goldman Sachs. And then in terms of a bear market, I think that Goldman has already kind of experienced a bear case scenario compared to what they were trading at prior to COVID. But I think that with continuing, pretty poor market conditions in the globe as a whole, if we weren't to be able to recover, I think we would see it continue to go down, maybe to about a $160 price target or a 13.5% downside. But like I said, I think Goldman's kind of already experienced that. And so, like we've said earlier, I think this is probably a great time to buy. And if anybody, I guess, has any questions, this would be the time to do it. I think that's pretty much it.
Yeah, and one thing I just want to add before questions, so when Colby was talking about the model that we did, Demoterin, who's like the dean of valuation, he's this infamous professor that teaches at NYU Stern. He has an entire website that has like 1 million financial models for different types of things, like different types of scenarios, whether that be financials or like a firm in distress, like all these other things. So I think going forward, that would be something as analysts that you would definitely want to take a look at. And he has like his thoughts on risk-free rates and everything, and like growth rates and how COVID affects the markets. And he's just such a smart guy. He's always on like CNBC and everything, and like all those business channels. And on a lot of Bentley professors teach, what he says and use him in their classroom as well. So definitely is like really helpful if you're ever struggling with a model. You can just download them right from Excel, and he kind of walks you through the assumptions and why they pertain to like that industry and stuff. So I could like send out the link or like send it to the like whatever the email, and so you guys can take a look at that. But it's just like Demoteran's website, and it's just really helpful. But yeah, any questions though?
Yeah, nice job, guys. One question I had was, there's like a decent chance that we are headed into a recession, like once the pandemic is over. Did you guys consider at all the possibility of the US moving into negative rate territory? And how did that affect like your considerations on your model as well?
Yeah, I mean, I personally don't think we're going to see negative rates. That would be pretty tremendous to see that. If that were to occur, obviously the model would have to definitely be adjusted. I would say that their exposure to global markets as well kind of helps them in a sense, because they're not so dependent on the US economy. So their US rates would definitely have a significant impact, but I think their exposure to the globe would definitely serve them better, I guess, in that scenario. But obviously, if the US goes negative rates, you're probably going to see a decrease in the global economy too. So I don't think that's going to help anybody in their peer set in general. I don't know if that kind of answers your question, Steve.
Yeah, no, that's fair enough. Thank you.
I have a quick question. In terms of like the drawdown from their highs in February, where are they against like other US banks?
In
Like
terms of
the
their,
negative 48%
Yeah.
revenue. Yeah,
Sorry.
it was pretty standard among like most banks. I think some were even more. It was like in the 50s and the 60s. I don't know. I don't have the exact numbers, but they were all like significant decreases. I think it just it's hard to compare because not everyone has the same like segment percentages. So like you can't really compare Goldman to like Credit Suisse completely because it has different percentages, like more in investment banking, like less in asset management, like that kind of deal. So I think it really just depends, but I don't know. I think we tried to look at it like segment by segment, but they didn't have that information. So, like you couldn't compare like the decrease in just investment banking or like the decrease in just like consumers and like that sort of thing. But it was pretty standard. But we could probably do like a fact set screen for that for quarter ones. Yeah. Another thing is that not all companies reported quarter one earnings, I think, at this point.
Right. No, I'm just talking about strictly their stock price, because obviously the whole market sold off by like 35%.
The price. I thought you were talking
like
about
I was just wondering if they were more or less affected than their peers, and then that could give us some insight about the speed of their recovery and the misvaluation that occurred.
Yeah, I'm not 100% sure. I know like obviously everything's down, and they actually just went up like a decent percentage in the past couple of days, but I think that was kind of standard amongst the whole industry. But we could definitely
Max, so just looking at it like really briefly, Goldman was trading probably like I would say around like they were trading around 235, 245 in that range right before the drop. And then as of like March 23rd, when everything like hit their bottoms, they went down to like 135. And now they're already back up to almost 187. So I think they definitely bottomed out like everybody else. But in turn, like if you look at JP Morgan was trading at like 140 and they bottomed out at like 79, and now they're back at 95. So I think Goldman, honestly, like Elise was saying, it's pretty standard, but I think Goldman actually dropped more than some of their peer groups. And so the recovery that you're going to see is a little bit more. But ultimately, and when you break it down, I think that Goldman still has a lot of room to grow, especially with their price that they're at now. So,
right, yeah, I think my sort of thoughts on that would be like, I guess they would be a better position for a recovery, I think, because they can make more on the trading revenue with increased volatility, and they don't have as much exposure to like commercial banking as some of the other big banks. Right. And I don't think that deal activity has slowed down too much, so their investment bank should be all right. But
That's their thing. Their exposure to investments and like a lot of derivative trading and stuff like that, there's still room for their investors to make some money. So they're not as heavily impacted as something like, Bank of America, where they're more dependent on kind of like the random individual.
all right, sounds good. Thanks.
Any other questions?
Question.
Oh.
If not, good job to you guys. Sasha will send out votings today with the recordings as well as the PDF files. So you guys can all vote, and those will stay open a bit as well, like they usually do. But good job, your last pitch.
Great, thank you. I have to run to a group meeting, but I appreciate it.
And this is our last meeting of the semester, right, Yasmin, if I'm not mistaken?
No, next. Oh, we have Mirage pitching right now.
Oh, right. Oh, okay. Sorry, I didn't realize we were going still.
Yeah, no, we're gonna meet next time just for executive board, new analysts, and whoever else wants to join, just to introduce new leadership to the team.
Okay, great. Never mind. Thank you.
Cool. Mirage, Haley, whenever you're ready.
Yeah, sounds good.
Okay. We looked at Xylem. It's a water technology company. I'm Haley.
I'm Raj.
Start this. 1 second. All right. So I'll just quickly go over our investment thesis. So Xylem's competitive positioning as a water tech leader in the U.S., and they also support continuous innovation within their company. They meet a lot of the world's water, wastewater, and energy necessities as it relates to water. They're very mature in their industry comparatively to a lot of the other companies, and their history of giving back to communities indicates potential for that. All of those things indicate potential for future growth. We'll go over, I don't know, like the last presentation, a lot of the price target, current price stuff later, including the ESG factors, catalysts, and risks.
So now into the industry outlook. So water usage is growing more, and it's more varied than before with ever-growing population. So efficient management is to become more and more critical at the bottom line. Technology companies are using water as a key input just to track how much water is being used, where it's being used, and to see if there's a way to kind of save some of that water usage. Declining water quality is also becoming a global concern. Just like it's one of the biggest things is that there's a lot of pollution in our water, and they're starting to see like pathogens and biopharma waste being found in our water. So having better testing is super important. Is climate change expected to decrease global water quality? In the Paris Pact on water and climate change adaptation. And another trend is water reuse technology, which is something that Xylem really focuses on, is seeing how they can reuse the water, divert wastewater, and to see if there's any way to reintegrate some of that water back into the system. Some of the ESG material factors are lifestyle management. So how much money needs to be invested into projects for a given lifetime? Is there any way to like extend the lifetime or to make these more efficient in the long term? So materials and sourcing and efficiency, are the materials being used reusable and last during the duration of the project, which is a really big thing for any infrastructure companies, making sure that the materials that they're using can be reused again or repurposed. So you see that a lot in infrastructure and for renewable energy. And then access and affordability. Obviously, water should be accessible for everyone and affordable for everyone, and everyone should have clean access to water, which is another SDG that we'll get into later. So ensuring that their products can fit into their customers' budget and is accessible for everyone. And this little diagram is just some of the water industry trends going forward. And then this is a really cool picture to kind of see where the stress is for water. So obviously the countries with that deep red, purple kind of color, you can see where they're heavily impacted on water stress, where there could be a shortage of water, or maybe the quality of water isn't that great. And so one of the things that Xylem's trying to do is they're trying to get into, they're heavily in the United States, about 50% of the revenue is in the United States, but they're trying to go into emerging markets and deploy some of their infrastructure there too. And so some of the few things for the future growth, growing population globally is increasing the stress on our natural resources, especially water. A desire to meet sustainable development goals requires rapid growth of renewable energy projects, and water infrastructure is one of those things that needs to be integrated into a lot of systems. Some of the infrastructure right now is really outdated, and the water quality is the biggest thing. There's not a lot of standards set there. And so what they're trying to do is just integrate technology that allows the end user to kind of see what their water looks like, and allows for water processing plants to get a better idea of what is in the water that they're sending out. So it's important for grid operators to become more skilled. Uncertainty with climate change is increasing for the demand for water, and then wastewater treatment is increasingly desired too. So one of the things is, as people know that their water is more contaminated or polluted, there's definitely public outcry for better testing, and so they want to make sure that all their wastewater is being diverged correctly, and Xylem definitely produces a lot of technology around that.
Great. Just looking at Xylem specifically, so they're traded on the New York Stock Exchange. They were founded in 2011. Their predecessor was ITT Corporation. They also did a little bit of water treatment, but everything got majorly shifted in 2011. They operate in over 150 companies, mainly in the US, as Miraj already said. They have over 17,000 employees. They focus on water infrastructure and industrial/agricultural applications. So the water infrastructure is a lot more complicated. And then industrial/agricultural applications is a lot of like large water use things. They also have a leading portfolio of smart metering, network technologies, and advanced infrastructure analytics solutions for waters and electric and gas utilities. So they kind of are a little bit all over the board when it comes to water treatment, wastewater treatment, water technology, and stuff like that, which is pretty interesting because staying pretty diverse as it goes forward with climate change and stuff like that has become increasingly important for these water technology companies. Their CEO is Patrick K. Decker. He went to Indiana University. Something pretty cool about him is he serves on not only the Energy Environment Committee for Business Roundtable, but one or two more environmental committees and with other wastewater companies, and then is also looking for kind of the best innovations going forward with that. And then some ESG efforts, just touching on these briefly before we go deeper into it. So they focus on affordability, resilience, operations, education, awareness, and disaster response, which is pretty cool for a water treatment company because they're not only looking at where they can make money, but also how they can help in the emerging markets that they're entering in. They're also looking at a 16.6 decrease in water use intensity. So they're hoping to kind of educate people on water use and show where they can kind of reuse water they've already used. And then also a decrease in waste to landfill intensity. So they're also trying to, when they do the wastewater treatments and stuff, they're kind of pulling the stuff out and doing the best they can with it and increasing education. And then increasing a vitality index. So a lot of wastewater companies are doing this. In their, I think, sustainability report for 2018, they go a lot deeper into this. I can provide the link for that. It's supposed to be hyperlinked, but unfortunately, those did not come through. But essentially, the vitality index will just kind of continue to hold their growing it throughout, I think, the next 5 years as a goal, and then they see continuous growth in that for the next 15 years.
So this is some of their risks and mitigations. In terms of risks, they're seeing increased competition in the industry. There's their water safety concerns and a growing need for water globally.
Today we're going to be talking about probability density functions, and in this particular problem,
So yeah, the growing need for water globally and just different regulations, country by country, is super important for them to keep track of. But one of the things about the increased competition in their industry is, given that they're such a leader in that industry and they're really well known for the infrastructure and the quality of the technologies that they create, I think that they still have a pretty strong hold over their competition. in terms of coronavirus specific risks, continuity planning for water needs is really important, and then responding to concerns about water safety. As like more people are worried about what's contained in the water, I think their water quality and some of their kind of deep analytics stuff, it will be really important for grid integrators to incorporate. So some of the mitigation is that competition can provide an innovative culture. So that's definitely really, we've seen that in a lot of technology companies, that it does create a lot of change and really pushes them to be better. Xylem has a market cap to retain the competitive edge, and there's strict guidelines connected to water safety for customers, employees. It is a pretty big barrier for entry. So that's something to keep track of when you're looking at their competitors. They also provide employees with guidance on infection control. This is coronavirus specific again, supplying all sites with necessary PPE and material, and then addressing any potential worksite contamination with events of immediate response. So in terms of their ESG influence, they have really strong governance oversight, which will also support the competitive edge. Their 2025 goals keeps them on track to meet both financial and sustainability targets. Xylem has really strong sustainability integration into their business model. Even when you look at their like investor reports and presentations, they have just their typical one that they have, where they have some of the ESG integrated into the typical investor presentations, but also they provide a supplementary one where they kind of go over really in depth on what their ESG goals are and how some of their projects are helping them achieve that in the long term. And then another coronavirus ESG influence is like the donating a lot of water tech in support of temporary hospital efforts, and then supporting employee volunteering. And then they have this program called WASH Education. And then you have their ESG analysis. So some of their material factors are their 2025 signature goals. So one of the goals is that they have 16.5 global billion cubic meters of water saved, and they're trying to prevent water pollution, which is really important. Just on a global scale, you do see a lot more. The conversation is really growing over water pollution and making sure that companies are not putting their pollutants into the water, because it is creating a really big problem for a lot of third world countries. There's an 18.4 decrease in GHG emissions. They're trying to reduce the amount of injuries that they're seeing from the workforce. They're a leading advocate for sustainable water policy, and they're trying to reach their 50% gender parity in leadership. And then they're aiming to reach 25% representation in their leadership. And I'm sure once they reach that goal that they'll probably set another one, because they do really value ESG goals and integration. So we're probably looking at more of like 30 to 40% in terms of minority representation in their leadership. And then for their MSC.
I can dive back in. Sorry about that. My audio wasn't working. Okay, sorry. So for the third-party data, so they are one of 5% in their industry rated AAA by MSCI, which is pretty cool. Like the last company we pitched, kind of up there with their MSCI scores. MSCI, which was pretty cool, which I haven't actually seen before, they don't have any negative score attribution. So not a single one of their ratings from MSCI in all of the different attribution categories are rated negatively, which is pretty cool. Something also interesting to look at is they received an $800 million ESG loan, which has the potential, as they move forward sustainability-wise, they can decrease the rate on their loan if they do kind of increase their levels of sustainability and stuff like that. I have some more information on that too, if anyone's interested. It's a pretty cool, I think they're one of 32 companies that got that loan, and it's the first kind of in its group of loans, and they're the only water tech company that got that. They're ranked 7th in Fortune's Change the World list. They're the Global Water Awards 2018 Company of the Year, and then their ranking history for ESG, according to CSR, is in this graph below, which is pretty cool. They've just been constantly above the industry average. And here's just 4 of the SDGs that they mapped to that for their 2025 goals. So if you look into their sustainability report, they actually mapped their actions to all 17 SDGs, which is pretty cool. Clean water and sanitation, obviously really, really important. That's something they focus on pretty importantly. And then sustainable cities and communities. So when they enter these emerging markets, they look really, really deeply into what they can do and what the best practices are for that community. And then responsible consumption and production, this is kind of their focus on wastewater, and then climate action as a whole. They're also looking to decrease CO2 emissions going forward.
So I'm going to go into some of their comp analysis. As you can see, like most of the competitors here are they're significantly smaller than Xylem. If you look at their market cap, they're above and beyond most of their competitors. And there was only one company that we could compare them to, but again, their market cap was over 100 billion. So it wasn't really comparable for us here, but we're just looking at in terms of infrastructure. I think they just really have a better market cap. And they have a really high EV to sales that indicates future profitability. And as we see more companies look to integrate better water quality technologies, we're going to see a lot more sales attributed to some of their tracking and analytics software.
Awesome. And then I'll dive briefly into our DCF. I know we're running a bit short on time, but essentially we saw growth over the year. We're looking at a roughly 20% upside and a 9% internal rate of return, which is pretty cool. We did adjust for 2020 kind of decreased in revenue. So we cut each of the kind of multiples by either a half or a third based off of what we expected going forward after 2020 if things kind of do clean up with coronavirus and everything like that, just because obviously earnings will be a little bit lower and they might be able to have to kind of reevaluate some of their investing practices and stuff like that. But overall, we kind of see positive stuff happening with them. They didn't have anything super surprising. We don't see any crazy growth happening just because of the industry they're in. It's and they're decently mature for their industry, and but they'll also hold their own going forward.
So now into their price targets. So our base case, we saw a price target of 85 with 22% upside. As we see, like demand for high water quality standards continue to grow, Xylem will continue to innovate. We also see that more companies and more grid operators will try to incorporate better water quality technology. So we see a really big potential for growth there. But more so in our bull case of 125 with a 78% upside. Emerging markets choose the Xylem product, given that they are really passionate about entering emerging markets and giving back to the community. We think that a lot more markets would choose the Xylem products. And then technological innovation grows exponentially with a lot more breakthroughs. Obviously, that is really dependent on what types of analytical software that they're looking to support. And then the importance of better water quality is heavily emphasized by the public. So this really pushes the public to demand better regulation and then better quality water. So again, that really leads back to more analytical software and making sure that all their water is being tested. And then in our bear case, we have 65 with a 7.2% downside. We see that like potential continuous economic downturn spurs investors, and then they're not really looking to invest in Xylem infrastructure. So that's one of the things that we will be keeping a watch on.
Sure. Okay. So just for a conclusion, so things that we wanted to emphasize, they're only one of 5% of comparable companies rated AAA by MSCI for ESG. And then along with their upside, Xylem is known for an accelerating path of innovation. So all of the news reports on them and stuff like that, everything positive that's come out of Xylem is because of their kind of focus on innovation, focus on helping the communities and stuff like that, which I think is just kind of a great company for us to boast in our portfolio. And then their 2025 goals align directly with every single SDG, and they do not see any promise meeting them going forward. They recently released a report that basically said we're still on track for everything. Their earnings report for the first quarter does come out on May 5th, so we'll be able to see a little bit more with that. But yeah. Any questions?
Okay, awesome. So just to open it up to questions If anyone has questions that they want to ask Mirage or Haley.
Yeah, just real quickly. Love the company, love the sustainability aspects. I'm just a little bit worried about the valuation. Could you go back to your DCF tab and maybe explain some justification for the multiples you used? It looks a little bit high compared to competitors.
Sure. So
Looks like that 19x. I'm not sure. Maybe I
Yeah.
forgot, but it looked like competitors were somewhere around like 13.
I'm actually not 100% sure with that one.
I can talk a little bit more about that. Like if you scroll up